Good afternoon and welcome to the Paycheck Protection Program Loan Forgiveness webinar brought to you by Shumaker, Loop & Kendrick. My name is John Dombrowski. I'm from our Toledo office, and joining me is Jan Pitchford from our Sarasota office. Before we get started, I do want to give the boilerplate disclaimer that Shumaker's webinars and related materials provide information regarding particular subjects and are not intended to constitute legal advice. By participating in a webinar or presentation, you are not and do not become a client of Shumaker. Rather, entering into an attorney-client relationship is a mutual agreement requiring the exchange of information and execution of an engagement letter. So with that being said, today we're going to be talking about the two SBA rules that were issued this past Friday. The first one that we're going to talk about is the final rule on SBA loan review procedures and related borrower and lender responsibilities. And the second one is going to be on loan forgiveness generally, talking about what costs are included in the reduction formulas as well. So with that being said, I do want to at least give some background information about the PPP program and where we're at currently. As everyone knows, that was signed into law on March 27th by President Trump. About a week later, all the loans were being started, or all the banks started taking in loan applications, and within a weekend, there was $342 billion accounted for by the program. That compelled Congress and the Senate to do an additional round of funding. And today we have about $669 billion in funding for the program, of which $511 billion is currently being loaned out to small businesses. 44% of all loans have been going through small banks. That's small banks being $10 billion or less in assets. And of the 4.4 million loans that are outstanding under the program, 30,000 are actually for $2 million and above. And that $2 million number is important. We'll get back to that in a little bit. But first, just the general process as to how the loan review or the loan forgiveness application procedure will work. At the end of a borrower's covered period, they will submit a loan forgiveness application along with related documentation to the lender. The lender will have 60 days from the date that they receive the application, within which they have to return a decision to the borrower and also to the SBA. That decision will be an approval full, it'll be or denial with prejudice or without prejudice. What denial without prejudice means is that the lender was informed prior to receiving the application or within that 6-day period that the SBA is reviewing that certain loan. I don't expect that to really happen too often because the SBA is also within the guidance that came out. It's requiring the borrowers to reserve or save documents in their records for 6 years after the loan is actually forgiven, which means that the SBA also has 6 years within which they can review any of the loans and any certifications made. That is important because the next slide being, if we could flip to the next slide that says what will be reviewed actually. And I apologize, I will be saying next slide throughout this in order to get things moving. We're doing that from a central location. Next slide after the general process, please. So what will be reviewed? Back when this all started, the CARES Act had a provision that expressly waived what is called a credit elsewhere test, which is typically instituted for 7(a) loans under the SBA program. Well, after the credit elsewhere test was waived, as we all know, there was a number of borrowers that were brought out to light in the public, such as Shake Shack, the Los Angeles Lakers, and others, that while they technically actually complied for requirements to get a loan, it just didn't look good. And the SBA tried saving face by issuing these FAQs that they've been randomly updating without any sort of announcement. And back on April 23rd, they issued FAQ 31, which said that, and this is all in relation to the certification on the borrower application that says that due to the current economic uncertainty, this loan is necessary. So what the SBA did within FAQ 31, it says that public companies with access to capital markets are unlikely to be able to meet that certification based on a good faith standard. Then they followed that up 5 days later and said that that same standard also applies to businesses owned by private companies. The implication being that it applies to private equity firms and hedge funds. Then a day after that, they said that they're going to be investigating any loans above $2 million and other loans as appropriate. Now, within this time frame, what the SBA did was kind of tricky, and I'll give them credit on their part. They said that within FAQ 31, they said that borrowers that were not sure if they actually met the certification standard, they could give a loan back and there would be no ramifications from that point. Now, there was very little basis within the guidance and within the regulations at that time that a borrower could look at and say that they qualify for the uncertainty certification. The SBA, I believe, did that intentionally, and they kept that window open for people to give loans back, and a lot of people did give the loans back, and they kept that window open by only giving little bits of guidance as we went along. So that they ended up extending the deadline from May 7th to May 14th to get the money back. And then on May 13th, one day before that due date, they finally came out with some relevant guidance. And important here, said that any loans under $2 million, and that's including all the borrower's affiliates put together, any loans under $2 million will be deemed to have made that certification of uncertainty in good faith. Anyone over $2 million will have to present their case to the SBA or be prepared to do so if the SBA were to ask about that. Now again, that came out one day before the due date to give the money back, so I think a lot of people did, and everyone else over 2 million, we've been working with a lot of clients to make sure that they document that necessity, and there are certain ways to be proactive about it in case the SBA does ask in the back end. Anyone under 2 million though, although the current rules that were announced Friday, they said that all loans will be reviewed by the SBA or can be reviewed by the SBA. If you're under that $2 million threshold, you're still deemed to have made that certification in good faith. Nothing changes. The only things that the SBA will be looking for at this time will be whether or not a borrower is eligible, the loan amounts that they claimed for and the use of those proceeds, and the forgiveness amounts. If you're over 2 million, it'll be all those, and then also looking at the uncertainty certification that was made on the form. The eligibility is an important issue in this case. While if you have under 500 employees, there's absolutely no doubt that you're eligible, assuming that you were in business before February 15th and you paid some sort of employees or independent contractors. But some borrowers, they had over 500 employees, so they had to qualify based on other certificate or other standards underneath eligibility standards. First one being if the borrower has 15 million of tangible net worth and makes an average, and their average net income for the past 2 years is under 5 million, they qualify as a small business. Or the other way to qualify would be as you fit into the industry size standards within the SBA regulations that have actually been around for a bit. So we've been working with people on the eligibility issue because it is important, because if you're deemed ineligible for a loan, that means that number one, you have to give a loan back. It's not considered forgivable. And there's also loses the non-recourse aspect of the loan, meaning that if say general partners in a partnership, if the partnership to give the money back, then the SBA could go after the partners at that point. Now, if there is finding ineligibility, or if the lender receives the application and they find that there's some sort of documentation that's missing or the numbers just don't add up, they're supposed to actually work with the borrower to remedy these issues before they actually send a decision to the SBA. And next slide, please. Now, if after working with the lender and the borrower still disagree on the process or disagree on the end result, the borrower will have 30 days from the time that the lender sends in their determination to the SBA, which the borrower will be notified when that day happens. The lender will then, or the borrower will then have 30 days from that date to appeal their side to the SBA, and the SBA will consider everything that's presented to them. And as I said, the lender is supposed to work with the borrower in this process of if there is something that's questionable, the lender is supposed to go back to the borrower and give the borrower a chance to explain their position or provide whatever documentation is missing or necessary to support their position. Now, the SBA may also contact borrowers directly, and any failure to respond to an SBA request can lead to an automatic finding of ineligibility. So make sure if you do receive anything from the SBA, always respond in a timely fashion, so that way you're not deemed ineligible for the loan. Next slide, please. So we get into the fun stuff. We're going to the final rule on loan forgiveness. One thing before we go to the next slide, I do want to mention, you may have heard that there is some current legislation that's pending. It's expected that Congress passes an amendment to the PPP program today, or the PPP today, that might extend the covered period from 8 weeks to 24 weeks and possibly eliminate the 75-25 rule that Jan will be talking about later. But we're not sure what's going to happen to the Senate side, though there is some discussion on the Senate side also about extending the covered period. But for right now, the covered period as is, and until there's some sort of agreement with the Congress and Senate and signed into law by President Trump, we have to stick with the covered period as is. Next slide, please. So when we're talking about the covered period for payroll cost, there's going to be what's called the covered period, which is going to start on the date that the loan was funded and extend for 8 weeks after that, or 56 days. And if you have a biweekly payroll period or more frequent, meaning a weekly payroll period, it's only 2 boxes to check on the application mark or on the application. If you do have one of those, then you can apply for what's called the alternate payroll covered period, which begins on the first day of the payroll cycle following disbursement. We'll get into that, what that means in a second. We're going to do an example, but just a few other things when it comes to payroll costs. The guidance clarified that the costs that are included are costs that are paid or incurred. The CARES Act, unfortunately, because it was put out pretty quickly, there was some sloppy drafting, but it spoke of costs that would be forgiven as costs that are paid and incurred. And that had a lot of issues in terms of how that applied to cash basis or accrual basis taxpayers. Again, luckily, the SBA fixed that by saying it's cost paid or incurred during the chosen period, whether it's the regular covered period or alternate covered period. Costs are deemed paid on the date that paychecks are dispersed or the borrower originates an ACH credit transaction. They're considered incurred on the date that an employee earns the money, meaning they come to work, or if they're on furlough, the date they would have been scheduled to work as well. And if the payroll costs are incurred within the last payroll period of a given period, but they're not paid, those costs will still qualify, assuming that the cost or the payroll is paid on the next regular payroll cycle. Another important clarification, I received a lot of questions about this over the past few weeks. Payroll costs do include bonuses and also hazard pay. Now, keep in mind, bonuses and hazard pay will be lumped in with regular cash compensation, which means that's limited to that $100,000 annualized amount. And then also there's some caps for self-employed individuals. Little unclear, wish it would have been a little more clear, but first one being an owner employee is capped at the 2019 compensation. There's no guidance on what they mean by owner employee. Self-employed person that files a Schedule C on the Form 1040, they're capped by their owner compensation, again, based on 2019 numbers. Now for general partners though, they are capped at the 2019 self-employment compensation. However, it's multiply that amount by 0.9235, kind of taking into account the employer side of, the employee side of the FICA that's usually paid by employees. Now going back to the payroll cost period, just things to think about when you're calculating payroll costs. If you do qualify for the alternative payroll period, make sure you calculate the payroll cost under both. Choose the one that works best for you. But keep in mind that if you choose the alternate payroll period, that you do have to use that same period when it comes to the reduction calculations that Jan's going to talk about. So do both. One example being, say we have a hypothetical borrower that their loan is dispersed on June 1st. So that's the beginning of their covered period. 56 days after that would be July 26th. So that would be the normal covered period. Now the same borrower, they disperse payroll on June 6th, which means that June 7th can be the start of their alternate payroll period. And that would go till August 1st, which is 6 days after that date. So if the borrower chose to go with the regular covered period, then the June 6th payroll would also be included, even though that pays for work that was done prior to the covered period. The fact that the amount was paid during the covered period means that you bring in anything that was attributable to that payroll, you bring that in on that June 6th payroll. And then, of course, same thing that you go all the way till July 26th, and anything that wasn't paid by July 26th, if it's paid in the next payroll cycle, but in relation to up to July 26th, those amounts are forgiven. Now, if you switch it and you look at it, that same borrower and use the alternate payroll period, that means that that June 6th payroll date would not be included because the alternate covered period begins on June 7th, again, the first day of the payroll cycle. So you might not be able to bring in that June 6th payroll, but you'd have to do the equate, you'd have to check the math and then to go all the way out to August 1st. And same thing applies as for the covered period on August 1st. If there's any sort of payroll that wasn't paid by August 1st, but someone say worked on August 1st and they were paid for that date on the next payroll cycle, that amount is included as well. Let's see, one planning opportunity, one thing to think about, the guidance actually has not said anything about a prepayment of retirement or health insurance expenses. While we can't prepay payroll, payroll costs do include these healthcare costs and retirement benefit contributions, and there's nothing that says you can't prepay that, or if you're still working on 2019 contributions, contributing that. However, I want to caveat that with the adage that I always use. I'm a tax attorney most of the time, so one adage I always use is that pigs get fat, but hogs get led to slaughter. So keep that in mind going forward. Now, if we go to the next slide, we're going to talk about some non-payroll costs that are eligible. First thing I want to start out with, the alternate covered period that I spoke about with payroll costs does not apply for non-payroll costs. When we're doing non-payroll costs, you have to stick to the covered period that begins on the date that the loan was funded. Within the guidance and actually the application itself, we did receive some valuable information, and we're still need some clarification on other parts. As we know, non-payroll costs include mortgage interest, rent and lease payments, and business utility payments. When it comes to mortgage interest and rent and lease payments, one valuable thing that we found in the guidance is the fact that it doesn't have to be related only to real property. It can also be, we can also include any sort of rent payments or lease payments for business personal property instead. So please keep that in mind. Of course, there's no prepayments, or one thing the guidance did say is there's no prepayments of mortgage interest, which is forgivable, but it said nothing about rent payments or anything else. But again, one thing I would caution is just be conservative with it. I would stick to not doing prepayments of rent or anything because it's supposed to be based on regular payment cycles. So payroll costs is one thing, non-payroll costs is a little bit different. Just the way that the phrasing is in the CARES Act and the guidance that we've seen, it does say based on the regular payroll cycle, and also it has to be under a service agreement that was in existence before February 15th. Now I mentioned mortgage and rent payments, the business utility payments, that's created a little bit of uncertainty so far. We know that it applies, the way that the guidance says actually does say payments for a service for the distribution of electricity, gas, water, transportation, telephone, and internet for services that began before February 15th, 2020. With telephone and internet, I've been advising people that that would include cell phones since both of those, or since that includes telephone and the internet. The one that's been kind of tough to decipher so far is transportation costs. Gasoline, it seems a lot of people are seeing, because it is a commodity, it seems like that's something that would be included. The only thing that I have trouble with including gasoline payments is unless you somehow have some sort of pre-existing service agreement with a gas company or with a fuel company, that'd be kind of hard to justify because it's supposed to be, again, under a service agreement in existence before February 15th. Same thing with Uber rides or anything like that. It seems like it'd be kind of tough to justify. However, what I would say is when it comes to costs like that you're not sure of, try and see if you can soak up as much of the forgiveness as possible with payroll costs and other costs you are for sure going to be able to include, and then save those costs in the back end and work with your lender. I mean, because again, the lender will let you know if certain costs aren't eligible. I'm not saying trying to slide anything by them, but just include costs that you have a good faith basis that you believe should be forgiven. And if the lender thinks otherwise, they'll let you know, and then you can take out at that point in time. Now, the paid or the cost paid or incurred mantra is the same with non-payroll costs as it is for payroll costs, not the alternate covered period, but just for the paid or incurred thing. What that means is, say we have that same borrower that their loan began on June 1st and would go through July 26th. And in the middle of June, they pay for their May utility. In June, or in July, they pay for their June utility. In August, they pay for the July utility. So the May utility bill and June utility bill would both be included in forgiveness because they were paid during the covered period. So even though the cost would have been incurred in May, the fact that it was paid in June during the covered period qualifies the inclusion of that amount. Now, as for the July utility payment, you could include up to a prorated portion of that bill that's paid in August on the next billing cycle. So that'd be basically July 26th up to July 26th. So divide 26 by 31, and then multiply that by whatever the July amount is, and that'll give you an amount that you can request for forgiveness based on that amount. So we're going to go through, as you add up all these costs, the application's pretty straightforward. Just asks you to plug in a number of items, and as you go through, add these items up and then subtract certain items, you'll get to the initial amount of forgiveness based on non-payroll costs and payroll costs that you can apply for. But then you have to apply some reduction formulas, which means I'm going to turn over to Jan to discuss that.
Hi. First and foremost, I would like to commend all of you for doing all that you've done on behalf of your businesses during such a very, very difficult time, both professionally and personally. This has been just extremely complicated and confusing, taking many of us out of our comfort zones. I, for one, this dealing with math is just, I went to law school because I'm not very good at math. So here we are. I'm going to just share with you that I had 3 college students in my home studying online to finish out their courses for the year in March and April, and I was home working remotely. So we had some really interesting dinner conversations where they would complain about their collaborative projects or their Zoom meetings and their professors, and I complained about the SBA. So they've all now moved on, having taken their finals. So I'm looking at our turn to do the forgiveness application sort of as our finals. So what I'd like to say to you, let's all go out there and get A's on our finals. And when it's all said and done, I think we should all go out and get some spring break t-shirts that say, I survived the PPP. So that being said, if you notice, John got to impart all the good news. And now I get to be Debbie Downer and talk about the exclusions. So while the Lord giveth, the Lord taketh away. So the first topic you'll see is reductions in the loan forgiveness amounts. And I don't need to read them to you, but they're all detailed in the latest guidance that we just received. I think it was at 10 o'clock on Friday night. But before we delve into those exciting topics.
There's no weird access to this. You're welcome, my dear. Bye. Okay, I'll get you Chicken Little.
I think I should probably go into a summary of the 3 tests for reductions. There are 3 pretty simple tests for the reduction in the loan forgiveness amount. The first one, test 1, is what we call the 75-25 split. And that is the first test. During that test, what you want to do is you want to confirm that the total amount paid for the PPP loan for the 8 weeks dispersed to with the funds dispersed to the borrower equal first 75% of payroll costs, which John just covered, which includes the salary, wages, and tips up to the $100,000 annualized pay per employee for 8 weeks, which works as a maximum of $15,385 per employee. And then in addition, it includes covered benefits for the employees and healthcare expenses, retirement contributions, and the taxes imposed on the employee payroll paid by the employer. Then you have the 25%. That is the maximum total of, as John had detailed, the payments of interest on the mortgage incurred before February 15, 2020. And then you have rental payments under lease agreements that were enforced before February 15, 2020. And then you have the utility payments, which are under service agreements that are dated before February 15, 2020. So that's test number one, the 75-25 split. The next test is called the reduction in the FTEs. So how about all these acronyms? So FTEs is full-time equivalent employees. So we're looking at test number two, which is reductions in the FTEs. The way that you arrive at the reductions is you divide the average number of the full-time equivalent employees employed per month during the 8-week covered period following the borrower's receipt of the funding by either one. You have a choice. At least they're giving us some choices here. The first choice is you can divide it by the monthly average number of full-time equivalent employees per month employed by the borrower between February 15, 2019 and June 30th, 2019, or you can divide it by the average number of full-time equivalent employees per month employed by the borrower between January 1st, 2020 and February 29th, 2020. So that number should be equal to or close to 1. And to the extent that it is not a quotient of 1, the amount of the loan forgiveness is reduced by that amount. So that's test number two. Test number three has to do with compensation reduction in the salary and wages. So that is calculated by taking the loan forgiveness and reducing it by a decrease of more than 25%. So that is your threshold. That 25% is your threshold. And so that decrease of more than 25% in the compensation to employees that make less than $100,000 on an annualized basis. And we're going to cover this in more detail later, but under this new interim final rule, the IFR, this wage reduction is calculated before the FTE reduction. So basically, this new rule helps us understand how test number two, with regard to reduction in FTEs, relates vis-a-vis with reduction in wage and salary, which is test number three. Next slide, please. Next slide, please. I'm sorry, I missed that. Okay. So our first topic is what happens with laid off employees or reductions in hours when there's an offer to rehire or reinstate. And this does cover both test number two and test number three. And this information was new with the IFR that we received on Friday. It reflects in the addition of a new exemption providing that if a borrower lays off or reduces the hours of an employee, and during the forgiveness period or their alternate payroll covered period, the borrower made a good faith written offer to rehire that employee or restore the hours at the same salary or wage and the same number of hours worked by the employee during the last pay period prior to separation or reduction, and the employee or former employee rejects that offer, then that employer may exclude that person from its calculations of the FTEs. But there's a catch. They can only exclude it if the borrower maintains their records of the layoff or reduction and the good faith written offer and the employee's rejection, and the borrower must inform the state unemployment insurance office of the employee's rejection of the offer within 30 days after the employee's rejection. So they have indicated that they're going to provide more guidance on that on their website, which is listed on the PowerPoint. So, but that is a condition to being able to exempt those employees from the calculation. We want to caution everyone to please be sure to document each layoff or reduction in hours by making sure that everything's in writing and that you keep a copy of every written offer and have some evidence that the offer was delivered to and received by the employee, and require that the employee reject the offer either by a signed writing or some other method. Sometimes that might be email or a text message, but there should be some confirmation. Next slide, please. So what is the effect of a reduction in the FTEs, which is full-time equivalent employees? This is essentially test number two. So the reduction in the FTEs during the forgiveness cover period or the alternative payroll cover period compared to the number of FTEs during the selected period of either your February 15th to June 30th, 2019, or the January 1st period to February 29th period. Or you can have a special period for your seasonal employers, which can be either of those two periods that I just described, or it can be a consecutive 12-week period between May 1st, 2019 and September 15, 2019. So the borrower gets to choose the reference period. And that is what results in a reduction in the forgiveness amount based upon the FTE reduction. So then example that they gave in the new guidance is the FTEs during the chosen reference period would be 1 in the example. And if the FTEs were reduced, 10, sorry. If the FTEs were reduced to 8 during the applicable period, the forgiveness covered period or the alternative payroll period, the reduction is 20%. 10 minus 8 is 2, so the reduction is 20%. So an equal reduction in the forgiveness amount must be applied to the, unless, of course, there's one exception to this. So you take that 20% and you reduce your forgiveness amount by the 20%, unless, and we'll talk about this later, the FTE count is restored by the employer by no later than June 30th of 2020. Next slide, please. So what is the definition of the FTE under PPP? Again, this is applying the test number 2. So under the PPP, FTE is defined as an employee who works 40 hours or more on average each week for the borrower. And the hours of employees who work less than the 40 hours are calculated as proportions of a single full-time equivalent employee and then aggregated. Next slide, please. So how do we calculate the FTE? Again, this is test number 2. If you have an employee who works more than 40 hours each week, that employee is still considered to be an FTE employee of 1. However, if you have an FTE who's paid for less than 40 hours per week, there's a way to determine by 2 different methods what their FTE value is. Next slide, please. So first, the average number of hours paid each week by the borrower to each employee is divided by 40, with an employee working an average of 40 hours. So that's counted as 1 FTE. And those working under 40 hours are a percentage of the 40 hours. So average 30 hours per week divided by 40 hours equals 0.75 FTE. But there's another, for administrative convenience, a borrower can also just choose to calculate their FTE count for people that work less than an average of 40 hours per week as a half of FTE or 0.5 FTE. That's particularly useful for small borrowers who don't want to maintain records or do not normally maintain actual hour records for each of their employment. Only one method can be elected, and it must be used consistently for the chosen reference period and the forgiveness covered period or the alternative covered period as applicable. So once again, you have choices, but once you make a choice, they want you to stick with it. Next slide, please. What's the effect of a reduction in employees' salary or wages? This is test number 3. The borrower must reduce the total amount of the forgiveness with respect to any employee that was hired in 2020 or any employee who was not paid more than the annualized equivalent of salary of wages of $100,000 during any pay period in 2019, if the employee's salary or wages was reduced more than 25% during the forgiveness cover period or the alternative cover period, as compared to the reference period that we talked about, those 2 choices, January 1st to February 29th, 2020, your alternative choices. So the reduction is only on the amount in excess of 25%. So that's your threshold. And then the calculation must be done for each employee on an individual basis. So for an example, it's much easier in form of an example. If you have an employee's weekly salary during the reference period that is $1,000, and that salary was reduced to $700 per week during the applicable covered period, So that reduction exceeds the 25%, obviously, because it's more than the $250. So the first $250 of the reduction will be excluded from the calculation because that was your threshold. So the forgiveness amount then would be reduced by the $50 per week. So the difference between the $300 that it was reduced and the $250, which was your threshold. So that $50 a week difference is then multiplied by your 8-week period to come up with a total of $400. The language in the forgiveness IFR that we received Friday is not entirely clear, but we believe that a borrower can exclude any employee who during any single pay period in 2019 was paid a salary or wages in excess of $100,000 annualized, which works out to, if you have an employee that receives $4,167 for any one of 24 pay periods, or like if they're paid on the 15th and 30th of each month, $3,847 for anyone under 26 pay periods, which is biweekly, or $1,924 for any one of 52 pay periods, or if they're paid weekly. Thus, if those thresholds are met, it's possible to eliminate a significant number of employees from the calculation, even if over the entire 2019 year, that employee earned less than $100,000 in the aggregate. So the language straight from the guidance is exactly this. The amount of the loan forgiveness shall be reduced by the amount of any reduction in total salary or wages of any employee who did not receive during any single pay period during 2019 wages or salary at an annualized rate of pay in an amount more than $100,000 during the covered period that is in excess of 25% of the total salary or wages of the employee. So again, that is a way to exclude some significant numbers of employees possibly. Next slide, please. So how are we going to account for reduction based on number of employees relative to the reduction relating to salary and wages? How do we take test number 2 vis-a-vis test number 3? So the SBA, in order not to double penalize, they've decided that the salary wage reduction will be calculated before the FTE calculation. So in this way, the salary wage reduction applies only to the portion of decline in the employee's salary wages that's not attributable to the FTE reduction. So the way that the reductions are calculated on the forgiveness application is clearly indicating that you do the wage and salary first. An example that's given in the guidance is when you have a full-time employee's hours with an FTE of 1 and they're reduced to 20 hours per week. So now they're an FTE of a half, but the employee's hourly wage remains the same. In this situation, the reduction is attributed solely to the FTE reduction. So there's no wage reduction that needs to be taken and excluded on the forgiveness amount. The salary wage reduction applies only to the portion of the decline in salary wages that's not attributable to the FTE reduction. So by calculating those wages first, there's no reduction in the hourly salaries, in the hourly wage, it remains the same. So the only reduction is for the FTE change. In that way, they've avoided the double jeopardy there. Next slide, please. So restoring reductions or salaries or FTE numbers no later than June 30th, 2020. A borrower who has reduced an employee's salary wage count between February 15th and April 26th, 2020, which is the safe harbor period, or a borrower who's laid off or reduced the FTEs during that safe harbor period or earlier, can avoid a reduction in their loan forgiveness amount by restoring the salary wage and rehiring or increasing the hours of all FTEs to the levels before the safe harbor period no later than June 30th, 2020. So all that was very clear under the CARES Act, but this clarifies that this is definitely a safe harbor provision, but it does not change or affect the requirement that at least 75% of the loan forgiveness amount must be attributable to payroll costs. It's very clear that that requirement remains with this latest guidance. Next slide, please. So some good news is that there's no reduction in the loan forgiveness amount if an employee is fired for cause, voluntarily resigns, or voluntarily requests a reduced schedule. So it's stated in the forgiveness application that a borrower can exclude from the FTE reduction any employee who was fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours, but only if that position was not filled by a new employee. And of course, the borrower should always appropriately document the incidents in order to support this exclusion. As I stated before, there has been no change in the 75% requirement for payroll, except with regard to that right to reinstate, as I stated. There's no further changes expected to that 75-25 rule. So as provided in the forgiveness application, the total amount of forgiveness amount will be limited to an amount equal to the total payroll costs divided by 0.75. Next slide, please. A rule of thumb that we've been hearing is a suggestion that the borrower make sure that the total non-payroll costs do not exceed 1/3 of the payroll costs. So if the non-payroll costs are less than 1/3 of the payroll costs, it's important to try to recheck those figures to see if you can find additional non-payroll costs that are forgivable to maximize the forgiveness amount. So with regard to the 75% limitation, please note that it's applied after the reductions in the forgiveness resulting from the reductions in the salary wages, which is test number 3, and reductions in the FTEs, which is test number 2, as we've discussed. So those two tests are actually applied out of order. To assist you, there's 3 tests that you need to just check because the forgiveness amount is the lesser of the following. It's the lesser of either the aggregate payroll and non-payroll cost reduced by a reduction in wages, or test number 3, or a reduction in FTEs, or both, or the lesser of the aggregate PP loan amount. Your forgiveness obviously can't exceed your loan amount, or the aggregate eligible payroll cost divided by 0.75. So those are 3 tests that you should run to check and make sure that your forgiveness amount is the lesser of those 3. So 5 years from now, mark my words, there's going to be a final Jeopardy question, and the category is going to be 2020 pandemic. And the answer is going to be, what is the PPP? And I hope you all get it right. So John, I guess at this point, are we going to take questions? Next slide.
Okay, first question was, will this be recorded and sent out to all? Yes, we are recording this. It will be on YouTube, and we can also send this out to you. So if you do have a contact here at Shumaker, make sure to get a hold of them, and they will provide that for you. Or if not, just contact us and we'll do that. That was an easy one. Hopefully they're all like that. The next one, what about auto reimbursements for sales executives? And I guess this one could probably go along with another one that said reimbursements for phones for employees. I'm of the mindset when it comes to these gray areas of costs, unless there's some sort of regulation or guidance that says otherwise, I would, if you have a good faith belief that they should be forgiven, to include it, have some sort of rationale for including it, and let the lender make that final decision. Don't take it out on your own. Let the lender do that for you, because if they do, there's no penalty as long as you do so in good faith and you're not trying to defraud the system. As long as you do so in good faith, the lender will work with you and they'll let you know if they don't think those costs qualify. Now, when it comes to the payments, like for say like a phone, reimbursement of a phone, there's nothing that says that the service contract has to be between the borrower and the service carrier. Of course, one could imply that. But in this case, you could include that, but make sure that if you do include, say, a phone bill from your employees that you're reimbursing, that those employees give you all those phone bills so that you can actually support that payment with documentation. And going back to the auto reimbursement, if it's a payment of mortgage interest or a lease or rent payment, it is personal property. Again, I would try and reimburse that and see what the lender has to say about that. But again, as I was saying before, when it comes to non-payroll costs like that, wait till you soak up forgiveness with all those other costs and then save those kinds of costs on the back end. Just kind of soak up what's remaining there. Let's see. Jan, I think we have a few for you here. One would be, if we have an employee that works 37.5 hours consistently every week, can we only count her as 0.5 for forgiveness purposes?
Correct. Yes.
Okay. Or is there something though with dividing the 35 by 40 to get an increased, maybe a 0.75? Maybe I'm mistaken, but is there an alternate?
Well, you can do the actual, yeah, that would be possible as well.
Yeah,
But
I think
not a full FTE for sure.
Yeah, not a full FTE, but I think the 0.5 was just for
example, yes.
See, so as far as I understand it, the borrowers can choose between using the 1 or 0.5 method, or just doing the math and say 37.5 divided by 40, whatever that is. That's the percentage of an FTE that they are.
Right. Yeah, the 0.5 was just in the situation where they didn't keep track of hours, just for ease. But
Okay.
yeah, if you keep track of hours, it's absolutely possible to do the actual fraction there.
Okay. Question for me here. Does an allowable expense for cell phones, does that include the cost of phones, service carriers, applications on the phones, or all of the above? The way that the business utility payments are phrased, it's to a service carrier. And again, they're kind of looking at more payments to service carriers that involve some sort of commodity. I know we all have phones these days. They're all different, a little bit more, but that's a little bit different than something like, say, gasoline or water, stuff like that. So wouldn't include the cost of the phones, but would include the cost of the service carrier. Unfortunately, I'm not sure what the application fee might be, but I would just stick to the carrier costs. I have another one for me. I received my loan funding on 4/17/20. It was a pay date. 4/17/20 is a pay date, but the ACH originated the day before the check. When would my covered period begin? The fact that the date that the loan was funded, if that was funded on 4/17, that's the beginning date for the covered period. If that person has a biweekly or weekly payroll period, they could choose to start it on April 18th, which is the day after that. So for this person, unfortunately, the difference between the covered period and alternative covered period probably won't produce much of a result, but it might lead to a day or so difference. So I would keep that in mind. How much of the internet costs refers to IT services, if any? Probably none of it. Unfortunately, again, as I was saying before, that these are supposed to be payments to carriers, or payments for services for the distribution of some sort of commodity or some sort of utility. IT service people, unfortunately, as much as we need them, they're not a commodity, so can't include them. Jan, another question for you. How is overtime calculated in terms of wage reduction? For example, during the comparable period, an employee was working overtime and now they are not. Their hourly wage was not reduced, but gross pay was due to lack of overtime. Will this result in forgiveness reduction?
That's a good question. I haven't had that come up.
Yeah, unfortunately, we won't be able to answer all these questions right here. There's a lot of questions that we've heard repeatedly, so it's been on the top of our minds throughout this whole process, which is why it's so easy for me to rattle off some questions. And I'll admit that I lucked out and had the easy side of the presentation. Jan has some difficult questions to field here. But that when we come across questions like these, unfortunately, we just have to say talk to your advisor, or if you are currently a Shumaker client, please contact your advisor after this and they'll get a hold of us and we'll take some time to research that and figure it out. See, another one that unfortunately I have to have the same answer for. If we have some positions funded through federal and state grants, do we have to exclude the payroll amounts that fund those positions from the PPP? My guess is there's probably some sort of restriction, whether in the PPP Act or the grant that you got, that says you can't double dip essentially. And if so, I would probably, again, whoever your advisor is or your legal advisor is, I would ask them to kind of look that intersection. The one thing now that I'm thinking about double dipping, one thing I do want to note that throughout this process, the CARES Act, when it started, it did clarify, we received clarification that any sort of forgiveness of a loan, while usually the forgiveness of a debt is considered cancellation of debt income that you have to recognize, the CARES Act says that any sort of forgiveness under the PPP program is not considered income. Although interesting, about a few weeks through the process, the IRS then came out with its own notice and they said, okay, we agree that the income isn't going to be recognized for purposes of, or the income won't be recognized if the debt is forgiven. However, any costs related that you use PPP funds to pay for, you can't use that as a deduction on the back end. It's probably the right analysis if you look at the code and just grants generally. Again, they're trying to prevent double dipping. It's unfortunate. I mean, there are people that believe that Congress intentionally did not say anything about not allowing the disallowance of deductions with PPP funds. Some people believe that was Congress's intent, and others look at the IRS analysis and say it makes sense. But as it is right now, based on what the IRS has said, unless Congress and the Senate say otherwise, cancellation of debt will not produce income, but any sort of payments you make with these PPP funds are not allowed as deductions. So, and again, that's probably going along with that, the use of federal and state grants and using PPP funds to pay for those same costs, probably not allowed, but again, I'd probably check with your legal advisor just to make sure. Another question, for the covered payroll costs for a client who has health insurance and dental insurance coverage for employees, would both of those costs be included? Or is it just healthcare strictly? Similar to other questions, unless Jan thinks otherwise, similar to other questions, I haven't heard anything that says dental would not be included. I feel that dental insurance is part of overall health.
That's what I've been advising as well.
Yeah, so I would include that. And again, if the lender says otherwise, you can deal with it at that time. Next question, are FICA and Medicare taxes included in the forgiveness amount? I'm gonna have to make a very fine distinction here. You don't include the cost of the employer side of FICA and Medicare. However, you do not subtract out the amount that is withheld for the employee side of it. So you keep those amounts in. So essentially it's the gross pay that is being given to an employee. That's the amount that you include forgiveness. I know there was some tricky wording in the legislation. And actually in the legislation, the way that they drafted it, it said that for purposes of the covered period, for purposes of forgiveness, that would be the net amount of payroll. But then you'd use the gross amount for purposes of determining the loan application. Is really confusing. But they did come out with some clarification that said basically just use gross figures on both the application and the forgiveness amount. So we'll keep that going unless we hear otherwise.
So I see someone asked when the forgiveness application is due, and we don't have any guidance on that. It's feasible that people could be making payments on a loan and receiving their forgiveness after their payments are due. We would recommend you do it as quickly after the 8-week period, just because there's the 150 days before everything's final. But right now, there's no requirement as to an application date.
Okay. Got another one about condo association dues, whether or not that's included in non-payroll costs. Probably not. I mean, it's not mortgage interest and it's not any sort of rent payment. I mean, understand it could go along with the rent payment, but probably not at this point, unless we hear otherwise.
Someone had indicated, what if an employee just ignores the request and doesn't respond? Then you would just document that, the attempts to reach out to them, and that's the best you can do. It doesn't require an actual signature, just do the best you can under the circumstances. And then I see someone's asking if someone passes away. I think that under the intent of the guidance, that would certainly not affect the FTE. That would be something that you just want to document as well. Unless you, yeah.
No, I'd agree with that, because I think they have that same exemption for people that leave on their own volition and just still want to come back to work and all that. So
Right.
that makes sense with that. I believe that's all the questions that I see, unless you're seeing any others, Jan, that I might have missed.
No, I'm not, unfortunately.
Okay, well.
If the person that wanted the information on overtime, you can reach out to me with an email and I can get you an answer on that. I just did not come up in the guidance, but it's certainly something that I can research for you. If you would reach out to me, I'd be happy to help.
Well, I guess just thank everyone for attending. It's been looking forward to this all week and actually been looking forward to this guidance. So it's nice to actually just learn about it and talk about it and get it all out. Of course, if you have any questions and you're a current client, again, just contact whoever you work with here at Shumaker, and either they'll know the question or they can forward it to us. If you're not a current client, we'd be happy to have you on board, and just give one of us a call and we'd be glad to work things out and get things going. And please look for our presentation on YouTube and otherwise.
Thank you very much for spending your time with us. It means a lot, and hopefully it was helpful. Take care.
Bye.